Afternoon, everybody. Thank you for attending. My name is Mark Ross. I have the pleasure to moderate these fine gentlemen with lots of expertise in the market. We have a 30 minutes, and I'm quite sure that we will be held to this 30 minutes, so we'll go quite fast. If everybody can introduce themselves shortly in terms of, we have where you're coming from, Jeffries, names, please.
Yeah, I guess I can start. I'm Turner Holm, head of research in Clarksons Securities. I've been in Clarksons for 12 years, started out on the sales side, moved quickly over to research, covered offshore, covered renewables, most recently covered shipping. So glad to be here, glad to be along for the ride.
Good afternoon. My name is Constantin Baack. I'm CEO of MPC Container Ships. I've been in shipping and investments for the last 20 years. 5 years ago, we started a container company with a clear focus on smaller container ships. We are the largest owner of feeder container ships in the sizes up to 5,000 TEU. And as a group, MPC has also invested in other sectors throughout the years. Thanks.
My name's Ben Nolan. I'm with Stifel. I do equity research, have done for 20 years now. That's me.
Hello, everybody. My name is Symeon Pariaros. I'm the Chief Administrative Officer of Euroseas since 2007, and Eurodry as well since the separation of the dry bulk fleet from the parent company took place back in 2018.
Thank you, Seamus. So my first question is, we've been talking this morning since there's been presentations. I think Clarkson, you also did a brilliant presentation on how bullish you are on dry bulk. And everybody was, quite negative on container shipping. So I'll start with you, Constantin. So I think you must have had a great time, counting money last year and seeing your, chartering, employment book you have going forward. You're going to be doing that for a little while longer. What are you doing with all this money? What are your investors asking of you? What do you need to do with it? Can you just have more lavish Christmas parties, or what are you doing?
That certainly is a to-do on the list, for sure, the Christmas party. But no, joke aside, I mean, in general, I think shipping is all about, especially if you're a ship owner like we are, is all about capital allocation and trying at least to do the right thing at the right point of the cycle. I think this time around, we're not just in a shipping cycle, we're also in a technology cycle. So it's important to consider capital allocation very carefully. What we have done with the money is we have significantly delevered the company. I think with the uncertainty ahead, having a low leveraged balance sheet and be able to act is extremely important, to act on opportunities with the uncertainty ahead, not just the macro and geopolitical one, also the technology one. So that's one element. Secondly, in terms of capital allocation, next to deleveraging, we have paid out a significant dividend. I think we have been, in 2022, globally the listed shipping company with the highest dividend yield, about 40%, because we believe there are times to deploy capital and times to return capital, obviously without taking away the substance of the company. We operate on very low leverage with a clear focus on dividends at this stage. That doesn't mean we're not there to invest, but I think at this point in time, especially in container shipping, maybe also in other sectors, it is also about being a bit selective about growth in light of the uncertainties ahead. So that's kind of the main focus of our capital allocation. So priority one, return capital to investors, to keep a low leverage balance sheet going forward and be selective on growth, but do grow if the opportunities arise. And actually on container shipping, I wouldn't be surprised if we see some attractive opportunities in the course of 2023, given where asset prices and charter rates are at this stage.
From the stories I've heard this morning, that the next question, I'm going to go to your colleagues first, but I'll circle back on when are these container opportunities going to pop up, actually, because everybody's so flush with cash. Simos, sure. You also have a sizable fleet on the container feeder size. I've also taken a look at your fleet. I've also taken a look at your chartering book as you have going forward. So, well done, I have to say. What are you doing with your money? What are you
We are trying to do everything. We are trying to grow the company. We are trying to return capital to shareholders. Actually, we are returning capital to shareholders. Our stock today, our dividend today yields about more than 10%. We are trying to pay down debt. And we are doing all that together. And I think this is the proper thing to do. I mean, for a company like us, not looking at the future and invest in new ships would be something that could not ensure the future of our company, first of all, but also the benefit of our shareholders. Our shareholders are not only, day traders and people that care only about the volatility. We have family offices. We have people that want to stay with us for years. So we have to make sure that their capital...
So how, for us, Maas Capital, we're also kind of like investors. So we have about 85 vessels on the water. So and we invest across the space in shipping and offshore. We find it at times difficult. How? Because I see you have 9 new buildings on order, delivering this year and I think next year. How was the discussion with, your investors in terms of doing this type of investment as opposed to returning the capital to shareholders?
It was not only a discussion between the investors, it was also a discussion between us within the company of whether we should proceed with such an investment. At the moment, if we liquidated if we sold all these 9 ships, we would have made a huge profit. So, needless to say, the decision was very, very good. Also, the first 2 ships have been chartered out at extremely profitable levels.
So that, yeah.
The break-even levels for the rest of the ships are very, very lower than today's market is. Even at today's depressed numbers, we could still fix the vessels and make profits. Inflation is kicking in every economy, and I don't see any way that this will reverse any time. So I'm very optimistic about this investment. I think it will bring very, very good returns to our shareholders. And I think it was something that we needed to do anyway. We believe in the evolution of shipping and in the decarbonization process. We want to be part of it. And we thought that it was the right time to invest. We couldn't get the prices that they were 2 years ago, but back 2 years ago, there was not a charter market to give us any income. So even if we paid a little bit more than the lowest prices that were available.
So you see it as part of, rejuvenating the fleet, going to the standard in terms of you rejuvenate the fleet to get rid of your older assets in a good market, and basically just for the future going forward.
Well, the most important goal is to be able to produce good returns to our shareholders. This is why we did it. We felt that were good deals, and so far this is what the market proves. I mean, even if we went today to the yards and asked for to build a ship with a delivery on 2025, they would ask for more money than what we have contracted our ships. So there is no regrets at all.
Of course. Constantin, you also have 2 vessels on order, no? There's methanol fueled, I believe.
Yeah, we took a slightly different approach because we only ordered against charters. We have actually 4 vessels on order to 5,500 TEUs, where construction capex is lower than the EBITDA that we have secured with the initial charter. So, in my view, very attractive with high upside down the road and a full de-risking of the project. And we've ordered 2, admittedly very specific for a certain trade, 1,300 TEUs on dual fuel methanol. Going forward, I would not order any conventional propulsion vessels, only on a one fuel basis. I would always pay the optional premium for dual fuel because I think that will be required. The question is what is the right dual fuel choice, right? Yeah. Obviously, on the larger container vessels, it's LNG because the infrastructure is there, and on certain other trades, it's potentially methanol. I mean, we have a 15-year charter, and I think that's in terms of our new building in the 1,300 TEUs, It's dual fuel methanol. We have a 15-year charter against it, and very unique for container shipping, we also have a 15-year COA backing the charter. That is unheard of in container shipping, and will actually establish the first green corridor in Northern Europe. It is a niche project, admittedly, but it is a project where you bring together those forces who can actually make a change and potentially generate green corridors with the right distribution of risk and reward. And so a slightly different approach, but this is the way we would selectively approach growth in new builds, for example.
Thank you. Ben, I mean, we've spoken about this type of topics before. I mean, the decarbonization, I think every seminar, every conference you go to is high on the agenda. Everybody's talking about how we're going to be using new fuels. And somebody comes up and says, okay, all of that is bad. We have to go nuclear. I mean, interesting discussions. But at the end of the day, we're all sitting in the market and we have to take decisions about what we're going to be doing. Are the investors that you're talking to, and I know you talk to a lot, are they actually rewarding shipping companies for actually being at the forefront and actually leading the charge on decarbonization?
I'd love to tell you yes, but the reality is not at all. I mean, I think it might come up in a discussion as a box-checking exercise at most, but we have to be honest with ourselves here. Shipping is a trading business. It's a date not marry business. It's that way for ship owners. It's even more so that way for investors. They like to think that the companies that they're investing in are doing the right things for the right reasons, but really they're trying to make money, and in shipping they're trying to make money really fast. And so these are not investors, they're traders, and they will invest where they make the most money, not where it makes them feel the best. So as a function of that, I would not look to Wall Street to mandate economic change or environmental changes or regulations or anything else. That is not how it's going to happen. Wall Street works on returns.
Maybe if all other things are equal, yes, the investor would choose the green company, but everything else has to be equal. Otherwise, I fully agree with you.
Care to comment on your colleagues' statements?
Yeah, I mean, I think that it's maybe with eco ships, right? I mean, you can make money on eco ships, right? I mean, there is a real economic argument. So you might get some premium, higher multiple to NAV because you have more eco ships, but that's an economic return consideration. It has nothing to do with the environment. If you want to achieve Greta Thunberg's goals, investors are not coming to, dry bulk companies carrying coal, right? Like, that's the hard reality of it. It's they come to make money. They come to shipping for volatility, for beta, right? This is the risky piece of their portfolio, right? And I think that, what is the question for this panel is, what do investors want in 2023? Well, because they're coming here for risk, they don't want to take any unnecessary risks, right? They have economic, geopolitical risks, they have financial risks, they have market risk. What they don't want to take is corporate governance risk, right? Like, that's the clearest thing, is that, they don't want to take liquidity risk, so they want liquid stocks, and they want companies with good corporate governance, and obviously they want to participate in market upturns where they are. And when it comes to corporate governance, it's a very sort of vague and broad term. What does it mean? I think it's as simple as giving the money back to shareholders when you have it, right? Sometimes you don't have it, so you can't give it back. But at the end of the day, corporate governance is about giving the money back. And I think a lot of shipping companies have done a very good job of that, right? Even shipping companies that, maybe weren't at the top of some of these ESG scores or corporate governance scores before, really turned themselves around in 2022, right? And I think that's part of, we saw, discounts to NAV narrow. We saw fantastic returns in the stocks that were, they sort of experienced good markets because they gave the money back. And I don't think it's any different this year. They just want their money back.
So go ahead.
No, I was going to say, I would add to give the money back. I would add transparency too. Like, investors need to know what they're buying, because if it's just some black box, you're not going to get a good multiple on that.
So early conclusion is that what investors want in 2023 is basically what they wanted in 2022 and 2021, and likely going to want in 2025 as well if these things continue like this, which is return and the biggest bang for the risk that they're taking.
Yeah, absolutely, and getting back to sort of the environmental side, I mean, to that point, investors are not investing in shipping because they want some sort of ESG solution, right? Shipping companies are not environmental experts. That's not the business they're in. If they want that, they can go invest in that. But shipping companies should generally be they should be forward thinking and trying to do the right thing, but not trying to focus on from a Wall Street perspective, from an investor perspective. It's not trying to fix the world's problems. It's trying to make money.
If I could just add one more thing that I think is different this year. Clearly 2022 was about shareholder returns. I think one thing that I'm hearing more of, and both from the company side and the investor side, is about stretching out the runway of these really good markets that we've had, right? And so, you know, it's been talking a lot shareholder returns, but I think it's also, I think deleveraging, and we had a lot of that last year as well, but, you know, using that cash flows to also sort of de-risk these cases, especially when we're in some segments, we're looking at order books that are quite low. You know, being responsible with the capital, right? And bringing debt levels and break-evens to a point where, you know, those shareholder returns become sustainable, right?
But I mean, we have this discussion every quarter with every board meeting as well. And kind of like the discussion is, yes, there's lots of cash being generated, and you know, banks come up with all kinds of other creative stuff to increase your risk-free rate. Goes from LIBOR to SOFR to SIF to all the things that get tagged on. All of a sudden, your risk-free rate or your floating rate is 7.5. So yes, the panel that we had before on alternative financings, yes, I mean, it's almost in par. Just with the standard commercial bank senior loan, you're almost kind of like at the same level. So the impetus to actually de-risk is also a very, very financially sound one to de-risk, but it just pay down the debt because it's very, very expensive capital. But do you guys see this as well as in terms of how to say from investor point of view that leverage is going to become less and less? Because if cash is being generated, why would you keep using much leverage?
Well, what should they do? What should they not do? Is new builds in most cases, right? Like it depends. Like clearly, Constantin's talking about a niche deal, which obviously has fantastic terms, right? It's an unusual situation, I think, as you said, right? But I think that investors are wary about new builds, and because we see, container has come down, right, in part because of the order book, and we've seen order books build in some segments, not so much in tankers and dry bulk. But I think that's one thing that people are going to be careful of. Is not doing that. And I guess to put it another way about paying down the debt or share buybacks or whatever, it's about permanent changes to the capital structure, so that we can stretch out this runway of good markets. Because I think I've listened to a lot of people who've been around longer than me say that this is, we have good times now in many parts of shipping, but it's probably, it's not going to last forever. But, when you fundamentally change the capital structure, right? You lower the risk, your downside is less, and your upside is more too. So I think that that's going to be a key theme, is those permanent changes to capital structure in 2023 and being careful on new builds.
So how are we going to do this? I mean, the fleet is aging. I mean, in certain segments, we have 30, 40%, even higher in certain segments, specific segments, especially on the dry bulk as well, especially in the smaller sizes, that the fleet is old. We need to replace, and we get, how to say, from all the regulators, everybody's pushing for decarbonization, actually bringing down the consumption. And when I look at the older vessels in our fleet, and I look at, how to say, the new buildings that we have delivering, sorry, we did do buildings, and that is basically, the consumption is less than, it's 60% down just by the new type of engines that we are using and better design. So we're making a huge, step forward in that direction already. But my point is, we do have a large fleet that needs to be replaced. All I've heard today is that the yards are full. If you want to put an order in, it's going to be 2026, 2027. Capacity over the last couple of years, that was actually the latent yard capacity that was built up in China. And then in Korea, and just so to say, restructured and brought back down. How are the yards positioned to support the industry on its, how to say, more lofty goals of decarbonization and actually making it greener?
Maybe one perspective to that, I think the short answer is that there's not enough yard capacity to basically enable a decarbonization in the foreseeable future. I mean, you used to have 350 shipyards pre-2008. Now you're probably 100 to 120. And out of that, I would say 50% probably at most can build a big series of vessels, right? So the pure capacity is not there to enable a, let's say, new building spree, especially with all the big container vessels being ordered at the same time, right? The shipyards are full. So I think this is one element. And secondly, it's obviously the fuel question remains unanswered. I mean, we have ordered the dual fuel methanol vessels. The larger container vessels go for LNG. I think other sectors, and I always say container shipping is logistics. It's not shipping. Commodity shipping, tankers and dry bulk is even more difficult to answer that question because you don't know where the vessels will trade. So how do you supply the fuel? What's the right choice? And then obviously availability of main engines is another aspect. I mean, ammonia is all over the place. You can't order an ammonia engine at this stage, right? So it's really, it boils down to, it's a transition, and the transition takes time. If I look at the yard capacity at present, I think that is a challenging time on the timeline, but we should play it cool. I think, keep leverage down. I agree with that completely. Maintain a high optional value in your fleet, also in your slightly older fleet, and take it from there. I mean, that would be at least my approach.
So, Constantin, with the money that we do make, when are we going to be buying container vessels again?
I mean, second-hand container vessels, I think now we have bought aggressively in 2017 and 18. We have since bought very limited and have sold way more than we have bought. I think, the market is coming down, and now is more a phase of optimizing the fleet. Optimizing the fleet towards better consumption, maybe rather buy a scrubber vessel, for example, and optimize what you have without being kind of aggressive, either on the selling or on the buying side. But we would continue to look at second-hand vessels if the design is right, if they come with a bit of cash flow, and if the residual value risk, because this is what we manage. It's all about managing the residual value risk of a ship. If that is right, and it's slightly more eco, maybe not super eco, but kind of efficient, more efficient than the peers, then I think it's not completely off the cards to buy container ships still this year.
I'm not a container ship owner, so I might be making a fool of myself here. You just tell me. I wouldn't buy a container ship right now, and the reason is that you might get. Well, first of all, if you have a time charter, then maybe you can make sense of it. But if you don't, I think it's going to be a few years of pretty choppy market. I don't know if you guys share that opinion, but once you get on the other side of that pretty choppy market, if you're buying a secondhand asset, then you're facing an even bigger regulatory burden, and so you have unknown residual value risk a few years out, and a few years of potentially pretty cruddy cash flow is just not something that I think is very investable.
Maybe just to answer that right away, because I'm not suggesting to buy spot container vessels in this market, okay. Right? I'm suggesting to optimize fleet profiles potentially, if the price is right, if you can get a replacement of an existing vessel at a decent price with not assuming too much residual value risk. I mean, that is key. So a spot vessel in this market, I would definitely not touch.
Yeah. Okay, Ben, as you wanted to wager on to what to buy, not to buy, what do you think about the tanker market? When is the party going to be over?
Oh boy, this is it might be a different answer for the equity markets within tankers than it is for the ships themselves. I guess I've been doing this long enough so that I've become a lot cynical, and the cynic in me says, boy, I really can't find too many holes to punch in the tanker story right now. The order book is less than 4%. I mean, that's a pretty good starting point.
Certain segments actually negative fleet growth.
Yeah, yeah.
May I add something to what Ben is saying? Nobody mentioned it. When we're talking about decarbonizing the planet, we're talking about stop using oil mostly, coal, and later on probably gas. If almost 60% of crude goes to transportation, and most of it goes to cars, if you were a tanker owner, would you go and order a ship at $120 million when, for example, in Europe, you won't be able to buy a car that burns gasoline within the next 10 years?
Yeah, I wouldn't. I guess in some respects, as it relates to tankers, but generally shipping, I think there's two factors that are just fantastic for people that already own assets. Number one is this environmental aspect.
Yes.
Nobody's going to order ships. Well, great. And the only way they do is when their charterers fund them to do so. So, make me move. It's fantastic. And then the other aspect is interest rates being higher is just another reason that nobody's going to do anything. I own the asset. The equity risk premium has widened, but my cost into the deal has not widened. I mean, you're going to make a lot more money than you used to I think in shipping generally, but certainly in tankers.
No, but definitely agreed. You hold on to your assets, milk them, delever, take the risk down, and enjoy it as long as you can, because it is it's replacement costs, and there's been quite a few new building parity lines drawn today in presentations. It's just going to be pulled up and up. I think a gentleman from Clarksons on the previous, the banana, the new building parity banana. I think there's going to be a lot of, I would say, higher and higher bananas going forward. But Turner, to you. I'm in a bit of a, per se, conundrum. Do you like dry bulk, and would you want to buy them this year?
Yeah. Look. So I think one thing that I'd probably like to make clear about my presentation earlier. So Ben and I have the advantage of being able to think in much shorter timelines, right? So we're talking about stocks, right? You can buy and sell a stock in the same day. You're probably not going to do that in a ship, right? So look, I mean, dry bulk has its challenges. I mean, there was the gentleman from Maritime Strategies presented earlier, talked about, issues with the property market in China. I mean, in infrastructure spending, it's a different economy. I mean, clearly there are risks down the road for dry bulk, but what you're looking for as an investor in shipping is asymmetric risk reward combined with volatility, which means you can make a lot of money if you get it right. And when we look at 2023, we look at the set of opportunities right now, that's it, right? Dry bulk is it. Tankers was that a year ago. That worked out very well. I hope it works out with dry bulk this year. I think I've made my opinion clear, but I think those are the kind of relatively rare opportunities that we find in shipping, yeah.
I kind of agree with you as well. It is, I also have a microphone, so I'm also allowed an opinion. The only caveat I put to that is that, especially on the larger sizes, which are like, it's quite binary. And I was in Athens last week, and everybody and their grandmother and their neighbors is looking at dry bulk, and I tend to get very, very nervous when everybody is running in the same direction. Everybody's screaming, yes, we are contrarian investors, but we're all running like lemmings in the same pool.
You get nervous when the Greeks are buying or starting to buy?
Well,
that makes me very happy.
I'm very, very happy the moment I've already bought and they start buying.
You get nervous when the Greeks are selling. Then
the buying is mostly on the Cape-size sector. I mean, we haven't seen extensive buying in smaller sizes from the Greek market.
But a lot of people looking for Ultramaxes and Supermaxes. So anybody in the room, please give a shout.
So what was the comment you made? I didn't hear your last comment.
No, the last comment is that there's lots of people looking at the dry bulk opportunity, and a lot of people looking at the Ultramax and Supermaxes.
But I think it's really important to say that means that there's a lot of, because I see similar things, that there's and hear some similar things for the companies I cover. It's that there's a lot of dry powder on the sidelines,
Yep.
We issued a report on dry bulk at the end of December, and it was really actually starting to bleed into the holiday period. And like, is it too late? It was the most read report we've ever published, you know. And I just think it shows that people are really interested in dry bulk. They see the fundamentals lining up, and they're just looking for an excuse to buy. And all you need is rates a little bit higher. Is it going to come in 3 months or 6 months or 9 months? I don't know, but the money is there. The owners, right? Like you said, we just talked about them being interested. I see from the U.S. listed owners as well. So, I mean, I think what it tells you is that, and the stocks are performing, even though the spot rates now are not great.
No.
So there's an underlying tightness, there's an underlying willingness to deploy capital, and in the sense that, I think it's positive in the sense that if we do see the rates move, then I think we could see a flood of capital. I think we could see asset prices rise very quickly and stock prices rise very quickly.
Very good. I think we have to close it off. Thank you very much.
Thanks.